After a strong showing in the third quarter, the latest economic data is pointing toward a weak fourth quarter, suggesting the much anticipated economic slowdown is on the way. In today's video, we're going to look at the latest economic trends, how much of a warning sign they actually are, and what this means for real estate. Let's get into it. On this channel, I typically cover topics related to the real estate industry, and on my other channel, I focus on the broader economy. I'm making a change in moving my monthly economic analysis to this channel. The housing market doesn't operate in a vacuum, and trends in the broader economy can affect the supply and demand sides of the housing market. If you're new to this channel, my name is Eric and I am a professional economist in addition to being a licensed real estate agent, so I can provide insights into both the economy and the housing market that you'll be hard-pressed to find on other YouTube channels. Now, when it comes to the broader economy, it was smoking hot in the third quarter of this year. The latest GDP data showed the economy grew at a 4.9% annualized rate according to the U.S. Bureau of Economic Analysis, which was stronger than expected. This was the highest rate of GDP growth since the fourth quarter of 2021. If this was the only data point that we looked at, we might think the U.S. economy was rock solid. But GDP data is released quarterly, and more frequent monthly data is starting to paint a different picture. Non-farm payroll employment growth for October came in at 150,000 jobs, below expectations and noticeably below the robust job gains of 297,000 in September. The October job gains were the lowest since June of this year and also well below the 2023 year-to-date average of 249,000 jobs. At this point, you may be saying that this is just 1 month's worth of data. It could be just a blip. After all, we still have November and December jobs reports to look at to see where the economy is going for the fourth quarter. Ordinarily, I would agree with you, but we're also seeing weakness in consumer spending for October. Retail sales were down 0.1% from September to October, and while this doesn't sound like much, it does represent the first time since March that monthly retail sales growth was negative. Additionally, there were also some signs of cracks in consumer balance sheets in some recent third quarter data. Credit card debt reached $1.08 trillion in the third quarter, the highest on record. Credit card delinquency rates reached nearly 3% in the third quarter, the highest level in more than 10 years, and the U.S. savings rate remains at historic lows, coming in at 4.4% in the third quarter, down from 5.1% in the second quarter. All signs pointing towards future weakness in consumer spending, which is the largest component of U.S. GDP. So we clearly have signs of a slowdown across multiple indicators. Should we expect this to continue? We'll get November jobs numbers this Friday, December 1st, so that will be key to watch. Based on weekly data for initial jobless claims, we're not likely to see a big surprise in that November jobs report. For October, there was an uptick in initial jobless claims, which partially accounts for the weaker October net payroll gains. But for November, we haven't seen that uptrend continue. For the week ending November 18th, there were 209,000 new claims for unemployment benefits, which was the lowest reading since the end of September. So even if we get a negative reading for November payroll gains, it isn't likely to be significant. Bottom line here is that we're seeing signs of a slowdown, but not an imminent recession. For my economic intelligence report next month, we'll be in a much better position to assess fourth quarter economic growth and whether it could be the beginning of a recession. So, what does this mean for real estate? An economic recession or even a slowdown is going to affect the demand side of the market as income losses or at least stagnating wage growth make purchasing a home that much more difficult for the average buyer. mortgage rates have come down a bit and are likely to maintain a slow, steady downtrend as long as the bond market expects the Fed to start cutting rates next year. But they are still near record highs and are weighing on housing affordability. A drop in household income or slower wage growth will just make it that much more difficult for home buyers, especially since inflation is still running above the Federal Reserve's 2% target. From an analysis in a previous video, I found that a recession could lead to a 10% or more decline in the U.S. median home price due to the potential decline in housing demand. I'll leave a link to that video in the description down below if you want to check that out. As data comes in, I'll be covering it all and I'll let you know what the latest trends are suggesting for what's ahead. So if you want to stay up to date on the housing market and how the broader economy is affecting it, make sure you're subscribed and hit that notification bell down below so you know right away when my next video comes out. I try to release a new video each week except around the holidays like last week when we should all take a little break. If you like this video, don't forget to hit that like button to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.